Welcome to the Canadian-Slovenian Chamber of Commerce's Business Insights 2022 event. I'm Sonia Rosenworth, the Executive Director at the CSCC, and I'm pleased to present Episode 2, Economic Outlook, From Immunity to Beyond. Tonight's guest speaker is Robert Kavcic, BMO Director and Senior Economist. To host this event, let me present Simon Pribac, our International Business Development Officer in Slovenia. Simon, the floor is yours.
Thank you, Sonia. Thank you and welcome again. As Sonia mentioned, to our Business Insights, the second episode with our guest speaker, Robert Kavcic, BMO Director and Senior Economist. Just for the start, a quick disclaimer. This event is presented by the Canadian-Slovenian Chamber of Commerce. However, the content presented herein is that of the presenters. It does not necessarily reflect the views of the Canadian-Slovenian Chamber of Commerce or their affiliates. It's for general information purposes only and subject to change without notice. All information in this presentation is provided in good faith. However, we make no representation or warranty of any kind expressed or implied regarding the accuracy, adequacy, reliability, availability, completeness of any information presented within. Any associated requirements, including but not limited to government legislation, taxation, or any other legal requirements, are the sole responsibility of your company. This information is general in nature and is not intended to be legal or tax advice. For specific situations, you should consult the appropriate legal, accounting, or tax advisor. No portion of this document is to be copied or distributed in whole or in part without knowledge and permission from the Canadian-Slovenian Chamber of Commerce. And now some brief housekeeping points for your information. Please stay muted so that we may all hear our presenters. There will be an opportunity to participate at the end of the presentation during our questions and answers session. Note that we'll be recording today's event and posting it on YouTube. Actually, we are already recording as you speak. The link will be shared on the cancelo.com website, Facebook, and email to our members and associates. We would prefer that you keep your cameras on, but you have the option to turn yours off. There will be a message that notifies you when we begin recording. So actually, we already started this, as I mentioned. I would like to take this opportunity to take a gallery view of our participants today. You may turn off your camera if you do not wish to be photographed. We are just making a group photo of everyone. Just for a second. So do we have a gallery view now? Yes, smile for a second. And we will go back. Thank you. So you are invited to post your questions and comments in the chat throughout the presentation, which we will address in the Q&A session, or you may also email us at info@cancelo.com. So, ladies and gentlemen, dear visitors, I would like to present our guest speaker, which we are really happy and proud to have, Mr. Robert Kavcic, the BMO Director and Senior Economist. We are pleased to present Mr. Robert Kavcic at the CSCC Business Insights guest speaker. Robert is one of Canada's most recognized economists, appearing on TV and publishing in our top business publications. He's also a Canadian-Slovenian, sharing a heritage with many of our viewers today. Robert has been with the Bank of Montreal since 2006. He plays a key role in analyzing regional economic and fiscal trends in Canada and the United States, and is the author of the Provincial Monitor and creator of State Monitor. Robert also regularly contributes to other department publications, including AM Notes, Focus, and econoFacts, and monitors equity markets from a macroeconomic perspective through the Global Equity Weekly publication. Tonight, Robert will share insights about the Canadian economy, the inflation story, and what this means for the financial markets. So first, we have the first poll question for you that are here with us today. What is the biggest issue facing your business this year? So, okay, so did everyone vote? Here we go. I'm just sharing the results right now. So most of you answered the biggest issue is lack of labor, and one about a quarter of you answered it's availability of inputs or price pressures. So right now, I would like to give the word to Robert. Rob, the floor is yours. I will stop sharing at this point and Robert will continue.
Okay, great. Thanks a lot, Simon, and everybody for coming on tonight. So I'll give you a bit of an overview of where we are on the Canadian economic outlook. And I mean, first question off the top, nobody said that demand was a problem in the economy. I didn't expect a single person to say that demand is a problem in the economy, because when we speak to the business community, it's pretty much all systems go for the economy and for business activity. Biggest problems out there, can't find workers, and you're dealing with price pressures and pushing those on to consumers, and that's driving up inflation. So that's basically the backdrop that we hear from the business community every time we do one of these presentations. So I'm gonna cover that and what the outlook is for inflation, a little bit on real estate, and what it means for financial markets. And then, of course, when we get to the end, if there are any questions or if there's something that I did not cover, I'm happy to go back and address some other issues. So first of all, when we look at the pandemic, I think we're all getting pretty optimistic that maybe this is finally the end, at least with respect to major economic disruptions and shutdowns and things like that. So the last wave of Omicron, you can see there that we did see a record number of cases. It's proving to be the fact that, yes, we are getting more cases, but they're becoming less severe in terms of outcomes. So therefore, we're not getting the same kind of hospitalization and ICU pressure. And therefore, hopefully, we're not going to have to put significant restrictions on as we continue to go through what are hopefully the last stages of the pandemic. And obviously, the big factor behind that has been Canada's very positive take up in terms of vaccination. So don't want to call this the end, but I think from our forecasting perspective, we are finally looking pretty clear in terms of economic disruption from this pandemic. And the talk now is us going back to normal, going back to work in places like downtown Toronto and starting to travel again with border restrictions being relaxed. So it's going to start to look more normal as spring comes and as we go through 2022. So from a growth perspective, when we look at the Canadian economy, we are, after a little bit of a hiccup in the first quarter of this year because of some of the restrictions we saw with this last wave of COVID, the growth outlook is actually very, very strong right through the end of this year and 2023. So for Canada overall, 4% growth this year, 3.5% growth next year. That is a little bit slower than we saw in 2021, but keep in mind that in a normal year in Canada, we're probably looking at growth of somewhere just below 2%. So even as these numbers start to slow down a little bit, the reality is that the Canadian economy is still growing at about twice the speed limit or twice the rate that the Bank of Canada would expect in a normal year for Canadian economic growth. So that puts us on a pretty solid path going forward over the next 2 years or so. In the labor market, what we've actually seen is a very quick recovery and a very quick tightening in the job market. And you can kind of see here just the first reality is that we did see a double-digit unemployment rate at the depth of the pandemic, but look how quickly that unemployment rate came back down. And really, however you look at the job market in Canada right now, the truth is that we have pretty much seen a full recovery in terms of the level of employment, unemployment, the unemployment rate, participation in different areas of the labor market. We are pretty much back to close to full capacity. And what's kind of striking is when you look at this cycle versus the one we saw after the financial crisis in 2008, 2009, look how quickly we've seen the labor market recover here. Back in the post-financial crisis period, so after 2009, it took us about 10 years to see the job market tighten up to the level where it was before the recession. And this time around, we closed that gap in probably about 18 months. So a lot of people like to look back at the last cycle and use that as a guide for what's coming in this cycle with interest rates and policy and growth in the job market. And I would just warn you that this cycle is very, very different than the last one. The last one was a credit-driven deflationary event that took a long time to get out of. This one is a lot different. This was a temporary supply shock, and now we've just seen so much stimulus put into the economy that we are seeing demand on fire across a lot of sectors of the economy. So it looks very, very different. The policy response is going to be different, and the growth outlook is going to be quite a bit stronger from here. So when you look at the household sector in Canada, one thing that's notable here is that because the labor market has recovered so quickly, and because we have seen so much in terms of federal to household transfers with all the various government programs like CERB and CRB and the various other support programs for small businesses, what has happened here is that households have actually accumulated a lot of excess savings. And so this is really the oddest recession that we've ever seen, in that it's the only one where household income has actually gone up, and it's gone up a lot, and it's gone up, well above the underlying baseline. And that is just simply because a lot of us, especially in certain areas of the labor market, like professional services, have been able to continue working, and those jobs came back very quickly. And the federal government pushed about $300 billion onto the household and business sector through various support programs. And what did a lot of households do? Well, they ended up saving a lot of it. So when we look at the outlook from here, yes, inflation is going to be a bit of an issue. I'll get to that. Interest rates are going to start to rise within the next couple of weeks. I'll get to that also. But households are pretty well cushioned overall because of all of these excess savings to absorb price increases and to probably absorb some higher interest rates. So I think there is actually quite a bit of runway here for policymakers to tighten up and still leave a pretty solid economic growth outlook. So on the inflation side, I think Simon has another poll question if you want to throw that one up before we get into the inflation story.
Yes, I do. And the question is, how much are the price increases affecting your business this year? Raising prices or absorbing higher costs? So let us just, there we go. So you can answer less than normal, no change, same as normal, or more than normal. Okay. Can anybody else vote? That's it. Okay. So the poll is ending. And there we go. Most of you answered more than normal, and a couple of people answered no change, same as normal. And I would like to pass the word to Rob. Please, Robert, go ahead.
Okay, so that pretty much makes sense, and that's consistent with everything we've heard, for the last 18 months or so from the business community, and what we're seeing in the economic data as well. That for the first time in a long time, we are seeing some legitimate inflation pressure. When you look at the actual numbers here, the US 7.5% inflation, 6% if you strip out food and energy. Those are 30-year highs, maybe a little bit longer. Canada, 5% inflation, 3.2% if you look at the core measures of inflation that the Bank of Canada likes to look at. And what that does is basically just strips out some of the volatile items so you don't get big swings. What this is telling us is that we are looking at inflation that is more persistent than policymakers thought a year or two ago. And we're looking at inflation that's running at the highest rate since the late 1980s. Now, it's not 1980s type of inflation when we were looking at inflation in the 10 to 15% range. But this is still a pretty clear break from what we've been used to, which has been 10 or 20 years of very, very stable inflation right around 2%. And so the outlook for this is some persistence on the inflation front. And we've actually been arguing for the last year and a half or so that we have more of a persistent inflation problem than a lot of people might be giving us credit for. And one of the reasons we've argued that is a lot of people early in the pandemic were analyzing this situation and saying, well, we just have supply side constraints, and that's why we're seeing prices get pushed up. The reality, I think, is that there's a lot of stimulus and a lot of demand in the economy, and we're probably not going to see these inflation rates back off until policy tightens and interest rates rise. And as you can see in our forecast here, it is coming, but it's going to be a pretty slow process over the course of the next 2 or 3 years to actually bring these inflation numbers back down to something that looks closer to normal. And even by the end of 2023, yes, inflation you can see is back down to around 3% or so in our forecast, but that's still about a full percentage point higher than we've been used to. So it's going to take a little bit of work to bring these inflation numbers down. Where is the inflation right now? What we do here is kind of just stack up where prices are falling and where they're rising in Canada. And unfortunately, most of the components of inflation are actually rising right now. In fact, if you really break down the consumer price index and look down to a granular level, about 85% of the components of inflation in this country are now above 2% or above the Bank of Canada's target. So that's just highlights that the situation here is not like we've seen sometimes in the past where maybe we have a spike in gas prices that drives inflation, or a spike in insurance rates or something like that drives inflation. This is pretty broad-based across gas, food, cars, airfares, consumer goods, and a lot of services as well. A few areas that prices are actually falling, things like cell phone bills, mortgage interest costs, which, not to give you a little bit of a spoiler, but I'll get to the interest rate outlook in a minute, and those rates are about to start ratcheting higher as well. So there's really not a whole lot of relief here. And the reason I say this is that the Bank of Canada will often kind of talk around some of the inflation pressures and call them transitory, or say they're going to go away and not have to tighten policy or raise interest rates. That's not the case this time. Because inflation is persistent and broad-based, the Bank of Canada is going to have to come out firing with interest rates, and they're going to have to come out firing pretty soon. So what do I mean about the demand side? So one of the issues that we see here is that there's just a lot of demand for goods and stuff. And if you look at the US, for example, so this is just consumer spending on goods in the US going back the last 10 or 15 years. And you can see we follow a pretty steady baseline growth rate of around 3 or 4% per year. But since the pandemic started, you can see what's happened there. And we've just seen a tremendous amount of excess spending, about $900 billion in excess spending. That's not spending on goods, that's spending up and above what would be normal in a normal growth environment. So this is really the root of the problem. It's not that supply chains are bogged down, or there's a shortage of goods, or a shortage of houses. The reality is that demand has risen so much that it's really swamped our availability to supply all of this stuff. Like you can only open up a factory so quickly. You can only build houses so quickly. When you have such a sudden increase in demand, you end up with this kind of inflation pressure. And so that's, I think, a story that goes kind of underreported, is that we are supply constrained, not because we're producing less, but because there's just so much demand out there that we can't meet. And this is one of the reasons I think central banks have now finally figured this out, and we are stepping towards some interest rate hikes. The other side is the labor market side of the inflation story. And what we've actually seen is a dramatic increase in demand for labor and a lot of job openings in both Canada and the US. We see about 7 million job openings in the US, about 700,000 or so. Actually, now latest number is probably about 1 million job openings in Canada. And these are record levels, and we haven't really seen anything like this before going back the last 30 or 40 years. And of course, what tends to happen when you're struggling to find labor, obviously the first valve for businesses, or the first way to draw that labor is to start raising wages. And so the next logical step here is that we are going to start to see some upward wage pressure. In the US, we are already seeing it pretty clearly. Canada is a little bit behind because by a number of measures, our labor market isn't quite as tight as it is in the US, but it's as tight as it's been in a long time. And so we are going to see some upward pressure on wages. And again, this kind of just reinforces the upward pressure on things like prices and assets overall. And then speaking of assets, one thing that always seems to get overlooked when we're talking about inflation and when central banks are targeting inflation, they do so with an eye on consumer prices. But what often kind of goes ignored is the inflation in asset prices. And what we've actually seen over the last 10 or 20 years is as central banks have cut interest rates towards zero and they've implemented policies like quantitative easing, where they're effectively, creating money to buy back bonds on the open market, has driven a lot of asset price inflation. And so look at what has happened to real inflation adjusted home prices in Canada, just as one example. We've really broken away from that baseline trend that would typically be supported by 4 or 5% income growth over time. And so this isn't just isolated to Canadian houses, which I'll touch on in a minute, but it's equities, it's US real estate, it's commercial real estate, it's all kinds of stuff, even cryptocurrency and gold and all kinds of stuff. It's just very broad-based asset price inflation that has come along with extraordinarily cheap money and a lot of liquidity in the financial system. So this is where we are right now. Question obviously is where we're going to go from here, and that's where it gets a little bit tougher. So on the housing market front, I'll spend a minute on this just because this is obviously a topic that always seems to come up for us on a daily basis, and what is happening here in this housing market. So there's a big debate out there right now because home prices, as you can see in the chart here, are rising pretty much at a 30 or 40% annual pace right now, depending on where you are in the country. Most parts of Ontario are running at about 30 or 40% per year right now. This is late 1980s type of home price growth. And there's a big debate out there about whether or not we're just seeing too much demand, or do we just not have enough supply? And there was a big panel put together by the province of Ontario just within the last couple of weeks, and their conclusion was, you know what? We don't have enough supply in this province. We need to go out and build 1.5 million homes over the next decade. Personally, I take the other side of that opinion. I think that actually there is quite a bit of supply coming on the market. If you look at what's happening right now, the truth is that we are looking at a record number of homes under construction in Ontario right now, about 150,000 or so, which is twice the normal run rate almost that we've seen in this province. So there are some issues, like it's taking a bit longer to complete some of these homes. We're producing more multis than single attached homes like we have in the past. So it's taking a little bit longer to complete some of these, but rest assured that supply is coming in Ontario. And so that is going to ultimately help to balance out the market. The other thing you got to keep in mind here is that what has really changed since the start of the pandemic. Look at the chart on the left side, that's sales, that's demand. And what we saw was an explosion in demand through the pandemic. And even as sales have come down over the last year, they're still running about 30 to 40% above what was normal before the pandemic. So this is demand. This is households looking for more space, households moving outside the core of the bigger cities. And more recently, within the last year, a lot of investor activity. And what has happened, I think, and where I start to get a little bit concerned on this, is that investors have started to watch home prices run at 10, 20, 40% per year. And now they've kind of started to piggyback and pile in on the market here and start to push it up a little bit above what is fundamentally justified. And I say this as somebody who has spent the last decade arguing that the market here is strong and prices are rising because they should be. But the activity we've seen in the last year or so is a lot more geared toward investors, which is a little bit more of a concern. And there's a lot of data out there on this from TerraNet, when they look at land registry data, what we've actually seen is investors now make the biggest share of home buyers within Ontario. The Bank of Canada has also pulled some data from the transaction level that is showing that yes, home sales are about 30 or 40% above pre-COVID levels, but sales by investors or multiple property owners are about 100% above pre-COVID levels. So at the margin, that's really what's driving activity right now. And so what I'm a little bit worried about here is that as interest rates do start to rise, and you do start to see some more listings come back onto the market, we're going to see a little bit of a soft patch for housing. And if you go back to what we saw in Ontario in 2015, 2016, 2017, what we saw there was a pretty frothy period for home prices as well. What happened early in 2016 is we saw a few policy changes with the foreign buyer tax and some OSFI rules, but most importantly, the Bank of Canada started to raise rates in 2016. And what that did was change the psychology in the housing market from one of rates are low forever and home prices are only going up to one where interest rates are starting to rise and buyers and investors started to sense a little bit of weakness. And once that moment happens, I think we're probably going to see something pretty similar, where home prices in some of the hotter areas correct, maybe about 10 or 15%, which is what we saw back in 2016, and then ultimately find a floor and stabilize, because the demographic fundamentals and the demand side is actually still very strong. We look at the job market and all of those factors that drive housing. What we have to do here is just take some froth out of a market that got about 10, 15, 20% ahead of itself over the last year because of all the kind of euphoria over home prices. I think that's going to come out, and then the market's going to stabilize itself, and we're going to be good to go going forward for a number of years beyond that. Okay, so now with respect to the interest rate outlook. So this is what we're looking at here in terms of rate hikes. So through the pandemic, the Bank of Canada and the Fed in the US, obviously, as we all saw, cut rates to zero. They sat there through the pandemic. And looking forward over the next year, we actually expect that next month, both the Federal Reserve and the Bank of Canada are going to start raising rates, 25 basis points at a time. The Bank of Canada is probably going to raise rates 4 times in a row, right out of the gate. And then probably a couple more times in 2023. So we're looking at about 150 basis points of rate hikes by the Bank of Canada through the end of 2023. Pretty similar story for the Federal Reserve. They probably raise rates a little bit higher than in the bank than in Canada because of just a slightly stronger economy, slightly stronger inflation backdrop south of the border. But so you can see here that pretty clearly the end of cheap money, or the end of free money, or zero interest rates, or whatever you want to describe it as, is going to be over in a couple of weeks, and it's a move higher. Really, the only question is how quickly those rates rise. In terms of longer term interest rates, you can see our forecast there on the right-hand side. We just see continued upward pressure on those longer term interest rates as inflation kind of sticks around. And then eventually we get up to levels that we saw towards the end of the last cycle. So what does it mean in the real world? So look at the mortgage market as an example. So 5-year fixed mortgage rates have actually already started to back up. They've already started to rise, in other words. So about 6 months ago, I think we were able to lock in at around 1.6% on a 5-year fixed for most people. Now we're already up about 100 basis points from that level, around 2.5% or so. And I suspect we're probably going to see about another 50 to 100 basis points of upside in those 5-year fixed rates. Look at variable rates though, because the Bank of Canada has held off raising rates to this point. We're still looking at a world where buyers can pick up variable rates at or slightly below 1.5%. Again, as of next month, this is probably going to start to disappear. And if we're to meet again at this time a year from now, I would say you're probably looking at again about 125, 150 basis points higher on those variable rates. So probably something closer to 2.75 to 3% on variable rates a year from now. So what's interesting here is that obviously everybody's situation is different, and you guys can take this forecast and run with it however is appropriate to suit your own needs. But what's interesting when you look at the Canadian housing market overall is that over the last year, for the first time, we've actually seen more Canadians take on variable rate mortgages than fixed rate mortgages. And Canada usually is very conservative in terms of taking on mortgage debt, where we have this long-standing preference for 5-year fixed rates in Canada. But because that spread widened out, and because those 5-year interest rates started to back up, Canadians actually shifted really in mass into variable rates over the last 6 to 12 months, unlike anything we've ever really seen before. So there's a little bit more rate sensitivity in the housing market, to the extent that, you know, if you're an investor and you're taking on a mortgage today at 1.4%, and a year from now you're looking at 2.5, maybe 2.75, well, you know, does that still make sense from you? So this is kind of one of the reasons why we think once we get 100 basis points or so into this tightening cycle, the housing market is going to start to really gear down quite a bit, just because so much excess has been built on top of 1.5% or lower mortgage rates, which, again, as of a couple of weeks from now, are going to start to become a thing of the past. Longer term, a lot of people always say, well, look at what happened in the US back in 2008, 2009. I'll just reiterate, as I always do, that this is a very, very different financial system, and we are very, very well protected. As much as we talk about buyers taking on 1.5% mortgage rates through the pandemic, most of them have actually been stress tested in the 4.5% to 5.25% range, in order in basically proving their ability to finance higher, to support higher interest rates. So yes, those rates are coming. Yes, the vast majority of home buyers have already proven their ability to service their debt at a much higher interest rate, which frankly, we probably won't even still see even at the end of this tightening cycle. That's how rigid that stress test actually is. So long story short, this is really just a story about an asset price, being houses, that got a little bit too frothy and too far ahead of what are still very strong fundamentals. Rates are going to rise. That froth is going to come out of the market. The market's going to stabilize, and we're probably going to remain fundamentally very well supported going forward beyond that. One last thing on financial markets, just to give you a little bit of a background here. So I mentioned some of the asset price inflation. Equities have obviously been another area that have run very quickly, and I suspect we're already starting to see the market correcting a little bit and starting to digest the fact that this era of extremely cheap money and massive liquidity is behind us. So this is just a very simple chart. That's the Federal Reserve balance sheet. That's effectively its QE program. So when the Federal Reserve effectively prints money and goes out and buys long-term treasuries, you see that reflected in their balance sheet increasing. That's the green line. And what do equity markets love? They love liquidity, and they love an expanding Federal Reserve balance sheet. So the problem is, when you look out over the next couple of years or so, the Federal Reserve is going to start to normalize that balance sheet, and that's going to be a little bit more of a headwind for stocks. We also have an inflationary backdrop, which we haven't seen for at least 20 or 30 years going back through history. And one of the questions that we've been getting a lot is, well, is because we're going into an environment that a lot of investors haven't really seen for decades, which is a little bit above target inflation, how do you invest in an inflationary environment? And so what we did was we went back and looked at all these periods back through history when inflation was running at, above 3%, so above the central bank's target, and looked at what kind of assets actually performed well or held value in real terms during those periods. Gold was always the number one, but that does obviously come with a lot of risk and a lot more volatility. But when you drill down into areas within the equity market, as an example, dividend stocks, so quality dividend stocks that are able to pay a consistent dividend and increase that dividend in excess of the rate of inflation, they hold their value very well. And even just look back over the last couple of weeks, what has held up best within the equity market? It's been exactly that. So a lot of the higher growth, higher valuation stuff like tech stocks and growth stocks have really sold off. Those just old school, boring dividend stocks have held up quite well. Real estate has held up relatively well in an inflationary environment. And then within the bond market, if if you have to go there, which is usually the place you do not want to go in an inflationary environment, inflation protected bonds are very short duration, treasuries and GOCs tend to be the best place to be. So the short story here are things that can generate income and increase that income at or above the rate of inflation hold up well. Things that are more on the value side of the spectrum hold up relatively well. Things that are very growth oriented or don't have a lot of earnings today, discounting a lot of earnings from the future. Think of like tech stocks and cryptocurrency and all that kind of stuff that's built on more speculative behavior. That's really the stuff that suffers when you have an inflationary environment and higher interest rates that come along with that. So that's just a very high level view of maybe where we want to start thinking about allocating some of our capital right now, just if we are going to be in this kind of environment for a little bit longer. And I think I'll leave it at that. I don't want to go on too long and give you a chance to ask some questions if you want. But so just to summarize here, I mean, the growth outlook is very strong. This downturn that we're in was exceptionally short. The recovery was exceptionally strong, and policy is still very stimulative right now. So we're going to see growth run at a well above average rate, still probably right through this year, right through 2023. Inflation is a legitimate issue, but I do think that it's very much a demand side issue that policy will be able to address relatively quickly. And it might only take, a couple of rate hikes to change the psychology and to get demand kind of simmering back down to something that looks more normal, and therefore kind of set inflation on a course where we gradually start to see it come back down towards something that looks a little bit elevated still, but back closer towards that 2 to 3% target within the next year or two or so. And then on the interest rate front, I mean, I think if I wasn't clear enough about it, let me make it very clear again. Rates are going to start going up very soon, and they're going to go up in pretty consistent increments, probably to the tune of about 150 basis points or so in both Canada and the US. And then I guess finally on the financial market side, quality and anything that gives you inflation protection is probably the place to be right now. A lot of the stuff that saw speculative froth build up through the pandemic, through the era of zero interest rates and exceptional liquidity, that's the stuff that is going to be tested most. If you really want a simple way to look at this, look back over the last month. Everything that's really struggled over the last month is probably going to continue to struggle. And the things that really stood out as being solid over the last month, some of the stuff we talked about, that's giving us a pretty good signal of what in financial markets are probably going to perform relatively well through this next phase of the cycle. Okay, so I'll leave it at that. Don't want to take too much of your time. And then if there are any questions out there, obviously I'd be happy to take any of those as well.
Robert, we have a few questions that some of our members sent us. So I would just read the first one of them. What should investors do in an inflationary environment?
Okay, so we kind of covered that, but just to reiterate, what has worked in an inflationary environment? Things that produce income that can grow at or above the rate of inflation. So dividend stocks, real estate, commercial real estate have typically held up well. And when I say dividend stocks, we're thinking things like Canadian banks, telecoms, utilities, REITs, real estate investment trusts. Those things historically have held up quite well in inflationary environments. And then the opposite of that is things that are built on speculation or built on earnings well down the road in the future. Those are things that struggle the most, because I mean, keep in mind what happens in an inflationary environment. If you're looking at a tech company or a growth company that's valued based on earnings that are coming 5, 10, 15 years down the road and interest rates rise, you're discounting those earnings back at a higher rate, and the value today really suffers. So all the work we do point to the same kind of answer, and that's really it.
Thank you, Robert. The next question we got is tighter monetary policy going to bring down asset prices?
So there are going to be some areas that struggle, and I think just the last couple of weeks have already given us a preview of that. So again, areas that were that saw a lot more froth and a lot more speculative activity build up over the course of the pandemic. Tech stocks, growth stocks, crypto, some areas of the real estate market as well. Those are probably areas that are gonna see some of the froth come out and correct. So, I mean, the timing on this, you never really know. We actually did a little bit of work the last couple of weeks too on looking at what has happened with the equity market overall once we got to the point where interest rates lift off at the start of a cycle. And typically what has actually happened, it's been very consistent. The equity market would always fall about 10 to 15% ahead of the first interest rate hike, which is exactly what we're seeing right now. And then very shortly after that first Federal Reserve interest rate hike, like within a week or two after, the equity market has typically bottomed. And it's actually done so almost every time going back to the early 1990s. And then so this is basically like a process of resetting the valuation in the equity market and kind of digesting the fact that now we're at the point where rates are going to rise. And when the market adjusts, then after that, you actually tend to see stocks rise again more broadly through the rest of the cycle, because usually rates are rising because the economy is strong. It just takes an adjustment in the asset prices to reflect the reality that money is no longer going to be cheap or free. And I honestly think that's exactly what we're seeing in the equity market every day right now. We're just getting ready for the inevitable reality that rates are going up. And the market's smart too, right? The market doesn't wait. The market always looks ahead.
Robert, thank you. We got another question coming in. It's what's the outlook for fiscal policy / taxation?
So in Canada, it's a good question. So the deficit has come down quite a bit, partly because we saw a lot of the emergency programs kind of run their course, and they've slowly but surely started to wind down, and a lot of that extreme spending has now kind of come to an end. And believe me, it was extreme. So when we're talking about like $370 billion on the federal deficit, we've never seen anything like that. This is World War II era of fiscal spending. So the good news is a lot of that is rolled off naturally. The bad news is that we're still left with about $50 or $60 billion that we're going to have to close, and we'll see what the Liberals' priorities are on that. Everything that I see suggests they want to continue to keep the taps at least partially open and keep spending on various priority areas. That was the case even before the pandemic. So I suspect we'll be kind of stuck with some of these larger deficits still for a couple of years going forward at the federal level. And then for taxation, I mean, I don't see too much changing in the very near future. If anything, there might be a little bit of a push at the higher end of the income spectrum, as we've, as we saw in the election platform, and keeping in mind too that the liberal government has a minority situation right now too. So they are going to need support from somebody. Typically, they've been leaning on the NDP, and a lot of the overlap between the Liberal and the NDP platform was taxation at the higher end of the income spectrum. So things like top marginal tax rates or the capital gains inclusion rate, stuff like that would be areas I would think might be at risk. I don't necessarily think they're going to go there, but those would be areas I would suspect would be at most risk of tax increases. Tax cuts, don't hold your breath at the federal level.
Thank you, Robert. Robert, is Canada's real estate market still safer than the US market was in 2008, 2009?
Oh, yeah, absolutely. I thought you were going to ask me, is it safer than the US market is today? And I would say no. I would say the US market is cheaper and fundamentally setting itself up for a decade of strength in the US. Canada was a bit farther. And we're actually quite a bit more aggressively valued and more susceptible to risk than in the US in terms of prices right now. But compared to 2008, 2009, no, it's not even the same. It's not even worth comparing. The financial system here is just so much more rock solid and so much more conservative. The lending standards that the Canadian banks use to write mortgages are just, it's not the same world. So we just don't have this systemic risk that we had in the US back in 2008, 2009. Just, it's not comparable.
Oh, thank you. What's happening with commercial real estate?
So that's pretty broad question for that asset class. But just like everything else, I mean, and cap rates are compressing. That's the short answer. And I mean, this is pretty much asset price inflation across the board. Within, I guess, a couple of things. Within commercial real estate, we've seen a few things, a few areas that have been relatively weak. And I don't mean that they've collapsed or really corrected a lot, but they've kind of been a little bit more stagnant. Downtown office and storefront retail has actually seen cap rates hold relatively steady, prices hold relatively steady. And when you think about the reasons why, I mean, it's pretty obvious. I am working here on Zoom today. I'm not in my office today. I've been downtown 3 times in the last couple months, and I've seen maybe 3 people. So, and trust me, when you look at what the banks are doing right now they're kind of trying to figure out, okay, how often are we going to make our employees come back to work? It's not going to be every day like it was in the past, obviously, depending on your job. Might be half the time, might be 3/4 of the time, but it's not going to be like it was back in 2019. So some of those areas of commercial real estate are repricing themselves a little bit in terms of cap rates and rents. Other areas have been exceptionally strong, like, and I'll give you one example, like warehousing and logistics space. It's been exceptionally strong because how have we shifted our shopping habits very quickly online at the start of the pandemic, and the commercial real estate sector is really seeing a lot of demand for things like logistics and transportation and warehousing. And so some of those areas of the commercial sector have been absolutely on fire. And we've actually seen cap rates in warehousing space come down below cap rates in some of the other areas like retail and office, which historically we have never seen before. So total relative repricing within the commercial real estate sector. And I know that's a long topic. If anybody is really interested in some of the details on that stuff, you can reach out to me. But that's a short answer in a couple minutes.
Thank you, Robert. The next question we got is, how is the Canadian dollar going to hold up against the US dollar and euro?
So a good question. I didn't mention it because really we don't see too much happening with the currency. Reason being that there are usually 2 things that drive the Canadian dollar. One being oil prices. We've seen a big increase in oil prices already. The Canadian dollar didn't move all that much. So the market is kind of telling us, I think, that it doesn't expect this increase in oil prices to above $90 to be permanent. But we do think that like oil prices are probably going to trade at a higher level for some time going forward for various reasons on the supply side and on the ESG side and things like that. So it's pretty stable outlook there for oil once we get past this Russia fiasco. The other factor that drives the currency is interest rate differentials between Canada and the US. And so what you tend to see happen when the Bank of Canada raises rates faster than the Federal Reserve, the Canadian dollar will strengthen, and vice versa. But what we actually see in the interest rate outlook now is both central banks are behind. Both central banks are going to raise rates relatively quickly this year and in 2023, almost step for step. So for the currency, where does that leave it? It leaves it kind of not really doing a whole lot because most of these factors balance each other out. And really at the end of the day, then what you're left with is the Canadian dollar is a bit So in financial markets, it's perceived as a bit more of a risky currency, and it'll tend to trade with the risk appetite in markets more broadly. And that's really what we're left with. So when you have weeks like the last couple of weeks where financial markets are struggling, you'll tend to see the Canadian dollar struggle. If we get past this and we go to an environment where equities and risk assets are stronger, the Canadian dollar will strengthen a bit. But I mean, for our forecast, it's basically high 70-cent range for the next couple of years. So not really much at all.
Thank you, Robert. Do you think that the current situation with Russia and Ukraine could have significant adverse effects on the North American markets?
You know, it's something that we look at, and we don't change our forecasts with little skirmishes. I don't want to say little skirmishes with events like this, because we see these often, like we saw with Crimea and the cases in the past where they're not immaterial, but they don't totally change our forecast. Is there a risk that it evolves into something bigger? Yes, and we'd be mindful of it. Like, we'll be keeping an eye on it, not changing anything now. I guess where it would most directly impact us today in Canada is through the inflation channel, because it is putting a floor under oil prices, and that very directly flows through gas prices here, and it flows through inflation in Canada. And it just kind of exaggerates what is already a pretty strong and pretty elevated inflation backdrop here. So that's directly where we're seeing the impact. But from an economic perspective, no, we haven't really changed much or gotten too concerned about anything yet.
Thank you. Can we experience deflation when the economy reopens because people already bought too much during the pandemic and may now shift to services?
Deflation. So I guess the interesting point that comes up here is, when we reopen, are we going to shift back to services? And that I think you combine that with higher interest rates, you're going to have two factors cooling down the demand for goods. And that should take some of the pressure off of inflation. As we're able to travel again, you're going to buy fewer TVs, you're going to buy less stuff for your backyard, right? As an example. So that will help bring down the rate of inflation. Is it going to create deflation? Probably not. What we're looking for here is we're going from this 5 or 6% rate of inflation back down to 2 or 3%. That's what we're aiming for. And I think that's where we're going to go. And in fact, like, when you look at the longer term, when you look at this from a much bigger picture, so beyond just this last cycle that we've been in this very disinflationary world for a long time, like 30 years. There's an argument to be made now that because of move towards ESG and carbon taxes and less of a push towards globalization, reshoring some production, tighter labor markets, a lot of this stuff maybe argues that this 30-year period of disinflation has come to an end, at least for a while. So I think you might not be talking about deflation for a while, like we were during the last cycle.
Thank you. What are your thoughts on cryo, medium to longer term? Are there any assets backing them?
Crypto? Was that the question?
It says cryo in the question, so I'm not sure. The person who asked that question, can you please clarify? Did you mean crypto or cryo?
It was crypto. Sorry, I just typing.
Oh, okay.
Sorry about that.
So it's crypto.
Sorry.
Oh yeah, that's okay. So I don't have a great answer for this because I just don't understand for the most part. So my philosophical answer to this is that, so you have a bubble in these cryptocurrencies, right? Which is what it is, but it's a speculative driven bubble. You buy the thing because the next guy's going to pay you more for it, right? It doesn't produce income or anything like that. But does that mean like it has no value? Like no. So if you go back to every bubble that we've had in history, the bubble initially, it was a bubble and it ran too far, but it was a signal of major change coming down the road for the economy, for the financial system. So a couple examples, like if you go back to the 1990s, we had a tech bubble, we had an internet bubble, a legitimate bubble in internet stocks, got way ahead of itself, corrected, collapsed on itself. But was it wrong? Like, not necessarily. Like, look at what we're doing today, right? And there are various other examples in history where something like this breaks out of nowhere, goes into a bubble, corrects, but ends up giving us a signal. And that signal is that we probably are going to see pretty wide scale adoption of digital currency going forward at some point. How do you play it as an investor? I don't know. If you buy Bitcoin or some of the other stuff, I just don't know. I don't know that stuff well enough. But 10 years from now, is the Bank of Canada going to have a digital currency that we trade in and we pay each other with? Probably. I mean, I would be pretty, I know they're looking into it right now and trying to create the plumbing for it. So I know that doesn't answer the question that you probably want answered. Should you buy this stuff or should you sell this stuff? Because I really just don't know. To me, it's a speculative asset right now, pure and simple. Either that, or it's also a medium to make transactions without any record and to evade taxes. But that's another story. It's another story, and to which there is value, by the way.
Okay. What is going to ease the labor shortages that we've seen?
They're probably going to stick with us, to be honest, for a while. So we're looking at, I mean, first of all, a lot of demand, right? There's a ton of demand out there. So when policy tightens, that'll ease off the demand side a little bit. But on the labor side, I think we're getting a preview of what is going to be something that plagues the economy for a long time, because certain areas of the labor market are just very undersupplied. And if you think of, I had a plumber come to my house today. And you know how hard it is to find a plumber? Like it's silly. Like if my kids are still too young, but if they were kind of toying with the idea of going to university or going to a trade school, I would say go to trade school, because we are very, very undersupplied, and that's a demographic story. So some of that is not really going to go away anytime soon. The other side of this, and this is especially acute in the US, because their immigration policy in the US is a lot tighter than we are in Canada, and they're starting to run into some problems with a very tight labor market. In Canada, love it or hate it, we are bringing in 450,000 people per year under the current immigration targets. We don't have a lot of housing to put them in, but we certainly need the labor to keep the economy running at potential. So it's not a simple or short answer. It's part of it is cyclical, that will cool itself down when rates rise. Part of it is structural, that's going to be, it's going to be hanging around here for the next decade.
Thank you very much, Robert. Do we have any other question from anyone? No? Okay, so Robert, thank you very much for this insightful presentation. And if any of our viewers have any questions or comments, please contact us at info@canslow.com. Those of you who are participating right now, and also those of you who are watching via YouTube. A note for the end, the Canadian-Slovenian Chamber of Commerce invites you to connect with us as our members, present valuable business expertise and insights. We hope that these events will inform and inspire you as we navigate together through 2022 with hope and promise. The seminars will be presented via Zoom and subsequently posted on YouTube for those of you who may not be able to attend the live events. And we, of course, invite you to join the Canadian-Slovenian Chamber of Commerce. Please visit our website, www.canslo.com, and go to the section canslo.com/about/membership to join our chamber. Again, thank you, Mr. Robert Kavcic, so much for this presentation and for your time. And thank you, everyone, for participating. And also, we would like to invite you to our next events on March the 2nd. We'll be having an event in Izola, in Slovenia. The event's going to be about doing business with Canada and the CETA agreement. Everybody is welcome. It's going to be in the beautiful town of Izola, next to the seaside, with gorgeous views of Adriatic Sea and the Alps. And the guest presenters will be Senior Trade Commissioner of Canada from the Embassy of Canada in Budapest, Mr. Francis Uy, and the Canadian-Slovenian Chamber of Commerce Executive Director, Sonia Rosenworth, who's here with us today, and myself. So welcome on the 2nd. It's at 7:30 a.m. Slovenian time, which means 1:30 a.m. Canadian time, but it's worth it. Also on the March 23rd, 2022, we'll have a really interesting event called the Humanizing Technology, AI and Robotics, which will be organized in cooperation with DDT Lab, which is part of the network of research art centers in Trbovlje, Slovenia, and McMaster's Innovation Center in Hamilton. We're really happy to be hosting Dr. Masha Yazbec, who is one of the main researchers in terms of robotics, artificial intelligence, and brain-machine interfaces in Slovenia. She studied with some of the world's top experts in robotics. So this will be happening on March the 23rd at 1 p.m. Eastern Standard Time or 7 p.m. Central European Time. Extremely interesting event with some amazing speakers. So for the end, we'd also like to say thank you to Mr. John Doma, the acting president of the Canadian-Slovenian Chamber of Commerce, who really made this happen again this year. So John has extended himself to donate to the chamber from the start, so we can be putting our events together, we can be putting our activities together. And we'll also like to thank the Office of the Slovenian Government for Slovenians Abroad, who also helped the chamber with support. So thank you very much. We're really pleased to have you. Also, we present our events on Radio Glas Kanadskih Slovencev at Chin Radio on 100.7 FM every Saturday from 8 p.m. till 9 p.m. And we also encourage the support of the VSKO, the All Slovenian Cultural Committee, and Slovenian Community Radio by advertising and sharing your announcements. So for more information about advertising on the Slovenian radio, please contact the program director, Maria Jovnišek, at maria.jovnišek@gmail.com or call her at 905-461-9818. So thank you very much. At the end, we have a disclosure from the Bank of Montreal. I don't think I will read that, but it's here just for everyone to see. Thank you very much. Again, thank you, Mr. Robert Kavcic, for joining us and sharing your time and expertise with our members and our YouTube viewers. And we'll see you again on the 2nd of March in Izola. Thank you.
Okay, thank you and good night to everybody. Laku noč. And like Simon said, hopefully we'll see you at the next events that are coming up. Thank you again. See you later. And you can look on YouTube for the recording. Thank you, Simon. Great job. Good night.